We're expecting about 350 to 500 million USD transactions in this year, in 2018. So the African story is really that it's on the up. People are finding yields in hotels in Africa, where the rest of the globe is starting to struggle. We can exclude this because of the financial crisis, but if you look at the general trend, that's where we are at the moment. To my next slide, this is quite an interesting slide for me. It really looks at it from a developer and investor point of view. A lot of people think that hotel investors are specialists in the industry, and what we've seen over the last 6 to 10 years is that the space has moved away from specialists in the hospitality sector to generalists. So in 2014, you saw that 38% of hotel investors specialize specifically in hotel investments, where at the end of 2017, that reduced to 29%. And that's the continuing trend, is that a lot of investors and developers are moving away from single asset specializations to generalized asset classes, if I could put it that way. A lot of mixed-use developments, a lot of portfolio investments where commercial might be taking a bit of strain, where retail might be taking a bit of strain, and they're looking for alternative asset classes, being hotels, medical, and to some extent, student accommodation. So the next question, which I think everyone has got, is where's the liquidity coming from? We've had that discussion today and yesterday, and what we've noticed is that there's a lot of capital raises coming into the market. Grit, for example, raising 130 million pounds they've raised capital to invest into properties in Africa, not just necessarily hotels. You've got the likes of Accor and Qatar that have just joined with the Casada Fund, $1 billion fund that they've established, $500 million in equity and $500 million in debt, specifically focused in expanding on the hotel sector in Africa. The Hospitality Property Fund, which is a REIT in South Africa, they specialize in hotels. There's a transaction that's taking place where they're acquiring the Togosan casinos, which has taken a bit of a bumpy road, so we'll see if that's going to happen. But if that happens, they're going to be the 4th biggest REIT on the Johannesburg Stock Exchange, which is quite positive. Investec and Growthpoint have done a JV together where they've raised $250 million for property investment into Africa. CDC, the capital raise for Onamo, where they are increasing their hotel footprint, and Gateway Delta, which is essentially the development arm of Grit. But the interesting one for me is this over here, which is essentially the sovereign states that we're seeing come to Africa, the likes of Theresa May and her dance in Kenya, and not just her. We've seen the German Chancellor and we've seen the French President having a lot of visits in Africa, because it is really the next story. They're looking for opportunities in Africa. There's supposed to be a slide up here. Can you get it up? There we go. Okay, so this is quite a tricky slide in terms of where Africa is in Eurobond yields and the love affair that we've got with debt on Eurobond yields. What happened is between 2016 and 2017, the Eurobond yields were driven down from 8% to 5.75%. The biggest reason for this is that investors were looking for higher yields because of what was happening in the world economy. There were some good key African markets that were in recovery at that stage, and a lot of the local governments decided that they wanted to switch local debt, which was quite expensive, into Eurobond debt. What happened in 2018? There was a sell-off of this. Reasons for that: US interest rate cycle, strengthening dollar, which obviously meant that the debt was going to become more expensive for African countries to actually service, and what's happening with the trade war between US and China. So that's why we're seeing it's gone up again to around the 7.5% yield. Where does hotels fit into the spectrum? Well, again, I'm going to reiterate that it is less volatile than the commercial space because it is a currency hedge. It is US dollar based and euro based. In terms of international travel, you are protected from that because people are going to spend in US dollars, and they're aware of that in Africa, barring SADC. Problem is regional travels. Travelers are obviously going to spend more money if they're earning in local currency, traveling from Ghana to Nigeria and so on. Right, so now we look at the macroeconomics and what's really happening with the momentum and the predictability of countries' GDPs and the, like we said, the momentum going forward. So we can split this graph into two. And what you'll see here is the countries like Nigeria, sub-Saharan Africa, which is an area, Ghana and SA. Barring Ghana, you've seen a lot less GDP growth in the economy. Nigeria and South Africa, the two biggest economies in Africa, is just struggling along. But what you'll notice is the change, which is the momentum shift there, is a lot more volatile than the right half of the graph. So volatility in Nigeria, if you look at that, you can see that it's come out of a recession. South Africa is sitting at GDP growth of 1.4, where change happened of 1.2, which means effectively last year we grew at 0.2%, which is a stagnant economy. So who would invest in these countries? That's the question that we need to ask, where on this side you've got good GDP growth and very little momentum change. In other words, you've got stability. So you've got that aspect of people investing into those countries. So on a more positive side, however, we've spoken a lot about transparency yesterday, and we're going to reiterate this because JLL does their own transparency index. We've been doing it for 20 years, and what we've noticed is that there's been a vast improvement in transparency amongst African countries. South Africa still sits as the one country that is exceptionally, well, it's transparent, it's on the transparency curve, but what we've noticed is Nigeria has been the best improver out of all the African countries. And the reason for that is that there's a lot of third-party providers that are giving property advice services to groups, investors, developers, and banks. So the likes of JLL, CBRE, W Hospitality, they'll do valuations, feasibility studies, operator selections, and when an investor needs this for bank funding or equity funding, whatever the case might be, it's important to have that, and that's been the biggest shift in Nigeria. In Kenya, they've also been quite a big move on the scale, but it's been a bit different for them. The biggest change that we've seen in their process is the progress they've made during the transaction process. In other words, signing an offer to lease or an offer to purchase to concluding that, as well as better data availability. That helps with council, approving for permits and things like that. So that's obviously improved business quite a lot in Kenya and in the likes of Nairobi specifically. When we follow this transparency index, there's 6 indicators that we look at. First being sustainability. How well built is the hotel? Is it a green hotel? The energy that you've got in there, is it your power supply, your water filtration, things like that? Is it a sustainable building? The transaction process, again, how difficult is it to get a lease or a land parcel through council to completion? Regulatory and legal framework, permits that you need. We look at market fundamentals where we actually compare the hotel sector to other sectors, retail, commercial, residential. We look at performance measurements, valuations of property. Have they increased year on year and what are they doing in the market? And then we follow listed REITs and their governance process, which we've seen has taken a vast improvement in the last few years. Sorry. Okay. So where are we in terms of yields at the moment? Yields are still under pressure. We've seen a continued trend for the last 20 years, but what we've noticed is that the reason for the yields being under pressure is that in Africa specifically, there's a great need for hotel diversification, and we need international brands within Africa. I think I saw a stat the other day that West Africa has got the 3rd most hotels in Africa in terms of its country, but it doesn't feature in the top 10 in terms of international brands. So in terms of acquiring good quality assets, it's still tricky to get that in Africa. So there's one of 2 things you can essentially do. You can do a greenfields or brownfields development, okay? It's going to take you longer. It's going to take you 3 years to develop. I mean, we've got examples of hotels in Lagos that took 8 years from start to finish. So building processes take long. It's going to take you 3 years to build, and you're going to take 2 to 3 years for your income to stabilize. So the question is, would an investor want to take a 5 to 6 year timeline on a property investment? I would say probably not. What happened in Nigeria 5 to 6 years ago from an economic point of view is completely different to where we are now. So the second option you've got is acquisitions of property. So to get a quality built asset is going to cost a premium. If you want an internationally branded hotel where you want the likes of Marriott, the Radisson to come in, it's got to be a quality asset, and that is squeezing premiums down. Then we look at the hotel performance. We're bringing this now back to West Africa. In terms of the key trends, there's still a lot of diverse economies that we see within West Africa. There's strong markets in the region. RevPAR, which is essentially the combination of your average daily rate and your occupancy, is still good premium available if in the right location and the right markets. So it's still there. Opportunities that we've seen in the market is extended stays, service suite type of hotels, and there's a big focus on development costs. That's still a big issue in this region. So what I've done is I've taken a few of the more prominent cities that we've done a lot of work in at the moment. You've got Abidjan and Dakar, which is really, these funds do exist and they have been established. You've got in 2017 with CDC supporting Onamo for their hotel rollouts, another 55 million of land is a big issue. So these opportunity costs are making it quite tricky in the hotel space in Africa. The trends that we are seeing at the moment, the shift that we've seen is that the ownership structure where previously international investors would have gone into a hotel by being a minority investor, they don't want to do that anymore. The majority of them want to be outright owners or majority ownership in terms of a JV structure. Target operating structures. In the past, if you speak to investors, they want a fixed lease. Banks want a fixed lease, but this doesn't exist in the hotel space. Very difficult to get. So there's been a big shift away from that to management agreements or variable leases, if you want to call it that, as well as owner-operators that we've started seeing coming through in the market. And then the preferred operator type, which is essentially the sort of brand that you want to have in there, outright majority, 72% of the people want to have an international brand in their hotel. This is another survey that we do at JLL. It's our Positivity Investor Sentiment Survey. And this is done with the brands, the hotel investors, developers, and it's really to find out where's Africa on their spectrum in terms of investment. What we've known is the top two lines is really the short-term and long-term goals of investors and developers, and more than 60% of them said that they want to increase their exposure into Africa. That's the trend. So we're seeing this trend the whole time of they want to get involved in Africa. They want to raise the liquidity for this. They're searching for the yields because you know that the yields, you're not going to get that currently in the UK, the Euro, or the US markets. Point this way. Okay. West Africa fundamentals. What does that mean for West Africa? And I want the next two slides to be more discussive point if it's possible. So what we've seen, the demand drivers, expanding middle class. We know that there's a population growth in West Africa. These people need jobs. They need places to stay. When they've got jobs, they need to travel. This is good for the hotel industry. Formalization of trade within the region, whether it be doing business in Accra, Nigeria, Lagos, there's going to be this travel, and the air supply has obviously improved quite a lot in the region. Infrastructure investment as an economic and tourism enabler. Basically, hotels provide jobs. It provides people with a place to work. So that's why you'll see the development banks being quite positive behind hotel developments because they know it's a job creator. There's a lot of market entry from global and regional corporates that we've noticed. And essentially there's high economic growth and there's increasing diversification. We've seen that in Nigeria, that you can't rely on oil for the economy alone. You need to diversify your economic factors and regions. And this is my last slide. Essentially, what we're addressing here are the challenges and opportunities within the hotel investment space in West Africa. So the opportunities that we've seen in the region with all the feasibilities we've done is that there are long-term macro fundamentals in place that are good. It's excellent in terms of what we want to do for job creation, for economic growth. It's there. Local developers want to take the lead in developing hotels. There's support for that to happen. Select service and mid-market remains largely untapped in terms of the hotel space, so there's opportunities there. The international brand penetration is slow and can pick up pace. And equity and debt markets, the liquidity issue is still, it is a problem, but it's an opportunity. If we're seeing all these institutional funds coming into the market, it provides us with opportunity for more liquidity in the market. Challenges, economic and political instability has created high volatility, and I think we've all seen that in the last 3 to 4 years. Divergent market condition, there's disparate growth prospects. Currency volatility, again, access to foreign currency is challenging, and the development costs are high, and it takes long. This is still one of the key issues investing in hotels in the West Africa spectrum. But not to end off on a negative note, there's positivity in the market. We can see the story, it's an African story, so we just need to figure out ways of how to execute, and I think it's going to be a good future for us.
Thank you very much.
Cool.
Thank you very much, Fabio. Are there any questions or comments? I think that was very clear. Thank you very much.